Hi, this is Stuart Williams, and thanks for listening to the Investopoly podcast. My goal is to give you simple, easy to understand strategies, insights, and tips to help you master the game of building wealth. And in this episode, I'd like to talk about the misconception that you must fund retirement purely from investment income. So that is, quite often people sit down and think, okay, how much in terms of investment assets do I need in order to have a comfortable retirement? And then they relate it back to the amount of income that they need. So if they decide they need $100,000 in retirement per annum, and they think they can earn an interest rate of, say, 3%, then they work out clearly that they need $3.4 million of assets. There are several problems with taking this approach, which I'm going to outline throughout this podcast, and then I'm going to present an alternative. So there's a bunch of different problems associated with taking this. And the first one is it results in a really lazy asset allocation. So if all your investments are invested in cash or fixed interest investments, and really that could be corporate or government bonds, term deposits, or just cash deposits, clearly in those sorts of investments, what you're looking for is a steady, reliable stream of income without any change to your capital. So, if you put a term deposit in the bank, you'll get an interest rate and you'll get exactly the money back again, and there's really no risk. Particularly given the government guarantees term deposits under $250,000, there's really no risk of you losing that capital. So if you're after income-style assets are great for that. However, the problem with that is there is no change in capital value. So as time goes on, inflation is going to eat away at your monies. So for example, $1 million today, in 30 years, $1 million in today's dollars is really equivalent to about $477,000, assuming we've got a 2.5% long-term inflation rate over that 30 years. So after 30 years, you've kind of got half the money in terms of purchasing power that you originally had. And that's a problem today, because if we retire at age 60, people living longer, medical technology will undoubtedly improve not only in the next just a few years, but certainly over the next few decades. So really we need to consider the likelihood of living to 100 and beyond. So if we're retiring today and at age 60, our money needs to last 40 or more years, or at least we need to consider the risk of our money needing to last 40 or more years, and therefore we must protect our asset base from inflation. So by saying, okay, I've got this amount of assets, I'll just put it in the bank and live off the interest, certainly it's a solution, but not a very good solution, because it's a lazy asset allocation and your money's really not working that hard for you. The second consideration or issue is taxes. So obviously if you say, look, I need $100,000 for living expenses, obviously that's after tax. So you need to provide for tax, and depending on how your investments are structured, that may be a little bit or maybe nothing, or it may be a lot. So if the taxes are going to be high, then obviously you need to earn a much higher pre-tax investment return. I guess the key takeaway here is consider ownership structures. Having a reasonable proportion, not all, but a reasonable portion of your wealth inside super also makes sense. As the laws stand there, if you've got up to $1.6 million and you draw a pension, it's entirely tax-free, although of course those rules could and probably will change. The third problem is that you don't have any negative correlation in your portfolio. So typically, income-style assets are negatively correlated to the share market, which means when the share market does well, income-style assets don't do as well, but the reverse is true as well. And so what you're trying to do, what the aim is with an asset allocation, I think that's an investor's most important decision, is asset allocation. That is, which asset classes am I going to spread my monies across and in what proportions. And I say it's an investor's most important decision because we can't control markets and we can't control returns, but what we can control is where our money is invested. So it's a little bit like supporting a football team, right? Particularly in the AFL. If you pick one team, you're very centric on whether you're going to have a good year or a bad year. If you support every team in the AFL, you're going to have a good year no matter what. And I guess that's a really probably poor analogy for asset allocation and sort of spreading your monies across different asset classes, but you need to do it in the right proportions based on your risk profile, strategy and goals and so forth. So if you put all your money in just fixed interest securities, look at the last 10 years as an example. Last 10 years, bond returns, yields have been below 3% and significantly below 3% for most of the last decade. They're only just touching 3% now. Whereas equity markets, if you look at the MSCI World Index, so World Global Developed Equity Markets, have performed just under 10% compounding over the last decade. So really, by spreading your money some in shares and some in fixed interest, what you're going to do is capture more returns, but also make sure that you've got a finger in each pie, that if a market or an asset class is going to do well, you can benefit from that, and that'll more than offset, hopefully over time, any asset classes that aren't doing so well. And so that it really comes down to asset allocation principles. The fourth concern is that interest rates might be lower for longer. So therefore, we need to be quite conservative with our interest rate assumption. Now, in the example that I begun with, I suggested a income return of 3%, but maybe to be conservative, we should choose 2 or 2.5. But if we choose to have that strategy that, okay, we're going to put all our money in cash because it's nice and safe and it's reliable and so forth, we need to consider the risk that interest rates might be a lot lower for longer. And some of the reasons cited for that is, quantitative easing and very loose monetary policy. It's hard to turn that stuff around. And certainly look at Japan. It hasn't been able to do that for a few decades. It's had zero interest rates for a long time. So it is difficult to turn that around. And so I'm cautious when I read articles to say, okay, interest rates over the next 30 years aren't even going to get close to what they were in the previous 30 years. I'm cautious because I'm cautious when anyone says history is not going to repeat itself, because it invariably does. But I certainly leave plenty of room for that to happen. So we need to consider the risk that we're not going to get a big return if we're investing our money in cash or fixed interest securities. The last concern is that you because you're forced to choose a conservative rate of return, 2.5% to 3%, whatever it might be, it forces you to overestimate the amount of money you need. And I'm going to go through an example in a second. But if we assumed, for example, that we're going to get a 6% or 7% return, we're going to need close to half the money than we originally thought. So by really understanding and having a better strategy that has a better asset allocation and therefore should in the long run expose the portfolio to better returns, it's going to help you in terms of reaching your retirement and lifestyle goals because you need less investment monies by the time you get to retirement. Okay, so can you use capital growth to fund retirement? So do you have to actually just take all your money out and think, well, if I need $100,000, then I really need to invest in assets that give me $100,000 of investment income? And as I said, if we take that approach, we're going to be forced to invest in a lot of income style assets, and I've talked about the problems with that. So a better approach is to say, okay, we're going to assume or adopt a robust long-term asset allocation, and that's going to require us to have some monies in cash, and we might need to dip into that cash. But whatever cash savings we spend to fund living expenses, we want to make sure that we're positioned to enjoy more than enough growth to offset that. So in the show notes, I've got an example of an asset allocation, and maybe, and I only use this for an example purpose. I'm not suggesting it's a good asset allocation. I'm not suggesting it's appropriate for anyone, but really just a few basic numbers. So I assume that 30% of a client's assets by the time they get to retirement is in residential property investments, 40% is in Australian and international shares, and that's mostly probably all inside super, and then 30% is in cash and fixed interest securities. So it's really someone that's bought a couple of investment properties when they were younger, contributed to super, then put some cash in the offset accounts to kind of reduce debt. So that's kind of a very typical strategy, I guess. If we apply some conservative return assumptions, that portfolio is going to generate $55,000 of income. So if the person needs $100,000, we've got a $45,000 shortfall. But the portfolio will also generate $70,000 of capital growth. So 55 of income, 70 of growth, 125,000 total gross return. We only need 100 to fund retirement, so 25 goes back into the investments and our investment balance appreciates. Probably doesn't keep up with inflation, so it's not a perfect example, but just to show you how the numbers work. So because we're only getting $55,000 of income and we need $100,000, we'll eat into $45,000 of our savings. But we're not concerned about that because our other assets, shares and property, will increase in value by at least $70,000 to more than offset us dipping into savings. And that's the way a good quality retirement strategy should behave. So that you've got a good quality asset allocation. Sure, you're dipping into cash, but you're also investing for the future and you're protecting against some of the issues that I sort of talked about previously, like inflation and longevity risk. You're living beyond 100 or close to 100 and so forth. The portfolio example that I've given has a weighted average return of 6.25%, so just over 6%. So you can see that you can have quite a conservative asset allocation, conservative investment asset allocation, and still generate a reasonable rate of return, and then that therefore is going to help you in terms of how much money you need at the end. So I hope that's been useful. As I said, there's plenty of links in the show notes to check out and the blog on our website. I hope that's sort of clarified this matter and put to rest the misnomer that you need to fund all your retirement from pure investment income. Okay, that's it for this week. Until next week, bye for now.